Yes, so for the global economy, the way I'd like to start is to think about where we were back last year. So in 2022, we were in a situation where activity was already slowing down and inflation was rising. So that's the worst type of environment for investors because there's absolutely no place where to hide. But since September 22, actually inflation started to peak, and we moved from that stagflationary environment towards one where growth is still weak, but inflation has started to decline. So the best position there would actually be fixed income instruments, as they are the ones that perform the best in this kind of environment. And regarding emerging markets, they actually behave a bit differently from the rest of the world, because growth is actually rising now and is even accelerating. So we might be in an environment where emerging markets could start to become attractive in terms of risky assets. So we are, for both major economies in the world, we are in a situation where growth is still very resilient and is likely to remain so, also weak, but it is likely to remain resilient because the monetary policy transmission is much longer this time than in any other previous cycles. And the reason for that is actually twofold. One is because we do have a lot of savings that have been accumulated during the pandemic that makes households less sensitive to higher prices or to higher rates. So that will make this entire monetary policy transmission longer. And the second aspect is because we have entered this monetary policy tightening with no excess leverage, again, making that process longer. So the implication for monetary policy is that they will be forced to maintain rates at higher level, again, for longer, to make sure that we do have enough time to slow down the rise of inflation. On the debt issue, again, what I mentioned is at private levels, there's no excess debt. The excess debt is taking place at the public level. So that may be the area where we need to focus on in the future. But on a more short-term basis, the main question is about the debt ceiling and how that can impact, obviously, risk in the market. And debt ceiling has always been an issue in the US. So since the 60s, they have to negotiate to increase the debt ceiling every time. But not every time is chaotic. And this particular episode seemed to be as risky as the one that we had back in 2011 for various political reasons. But having said that, what it means for markets is that obviously the short end of the curve will remain extremely volatile because you don't want to hold bonds that could actually default. But everyone is convinced, and every single investor is convinced, that the US will continue to serve its debt and to pay its interest on its debt in the future. So being long, the long end of the curve still makes sense as it was back in 2011. So we know that China is in a total different cycle and is actually recovering from a very low growth in 2022, 3%. We expect growth to be above 6% this year in China, and that will naturally have consequences for the rest of the world. There are usually two channels of transmission. One is through activity and the other is on inflation. We don't think that there'll be any global consequences on inflation, but it will impact activity globally. And the way we like to think of it is to think in terms of what are the channels of transmission from Chinese recovery. It will go through trade, it will go through tourism, and it will go through the price of commodities. If we focus on the first two, we take the assumption that Chinese imports will grow at 10%, which is reasonable in terms of assumption. On tourism, we expect Chinese tourists to reach half, so 50% of 2019 levels. And with these two assumptions in mind, then you can assess the impact that it will have on each economy in the world. And the economies that will benefit the most from that recovery, and when I say the most, it's more than 2 percentage points of their GDP, will be countries like Singapore, Vietnam, Thailand, so essentially Asian neighbors. But it will also impact commodity exporters in the emerging space, such as Chile or Peru, as well as it will benefit to some developed economies, mostly Asian ones, not too surprisingly, such as Australia and New Zealand, which on top of being neighbors and Asian, also commodity exporters, but Japan too, whose growth is supposed to be positively impacted by 0.5 percentage point. And last but not least, the impact will be less evident in the other two big economies in the world, Eurozone and the US, for which we estimate the impact to be even less than 0.1 percentage point. So emerging economies are in an environment where inflation has been declining fast because they don't have the same issues as developed economies has. And activity has been resuming for quite a while now and is on top of what I just mentioned regarding China, benefiting from the Chinese reopening. So we expect emerging growth to go above their potential trend. And that's generally an environment which is extremely beneficial to emerging markets. On top of that factor, we also have another one which is essential for emerging markets to outperform developed ones, which is the growth gap that emerging markets have with their developed counterparts. And that one is actually widening, so favoring investment in the emerging space. The one thing to watch, though, is that if we are correct on our soft landing scenario for the US, then it's an environment where the dollar should weaken. But the tail risk scenario is if we are wrong on our soft landing call for the US, and if the US goes into a recession, then we may enter a risk-off type of environment where the dollar would remain strong or could even become stronger, which would definitely be a headwind for emerging markets. Deglobalization, or the way we see deglobalization in general, is you see companies repatriating some of their production lines for two reasons. Because of geopolitical tensions or for strategic reasons on one side, and on the other side, because you want to reduce your vulnerability to countries far away from you, which could actually be hit by another pandemic, for example. So that's the process that is taking place in many countries. So the US are indeed reshoring some of their activities, but I don't think that this trend is sustainable. Again, I'm a firm believer in the principle of comparative advantage, and that companies will still look for places where labor costs are cheap and to continue to benefit from that. So instead of talking about deglobalization, I like much better to talk about reshaping of globalization. So we are entering a world where globalization will look different. And what I mean by different is it's likely to be more regionalized. And since we are talking about emerging markets, since we are in Asia, I think Asia is one place that could benefit a lot from this type of reshaping, because they are already extremely well integrated. There are many free trade agreements that put together all those economies. They are very diversified. We have countries with very high income per capita, with bad demographics, but which have high knowledge, who are highly innovative, and who are next to countries which have very favorable demographics, cheap labor, and who can be big recipients of all those capital flows that come from the first group of the countries. So I think that putting all this together would continue to benefit the entire region when we talk about the impact of the globalization for Asia, for example.